Welcome to Inside Scoop with Sean Emery. Every week we are examining something new, bringing you closer to companies, sectors, and themes. This recording should not be construed as a substitute for personalized individual advice from Avery and Company or any guest on the show. This is for educational purposes only and not intended to make an offer or solicitation for any companies or securities mentioned. With that, let's get on with the episode. Okay, welcome back to Inside Scoop. Happy New Year, everyone. This is Sean Emery, the founder of Avery and Company. Today we're doing 5 questions. If you don't follow me on Twitter, the handle is @_Sean David. That is @_SEAN David DAVID. You don't need that. You can tweet me, bi-weekly, any questions you have. We are here to answer some of them. Last year, I think, my Twitter DMs were packed with all types of questions. This year, what we're trying to do is essentially, continue to have these open discussions around key questions that are asked. So, anything is fair game. We'll have a little bit of everything, macro to building companies, to analyzing companies, investing themes that maybe we're interested in or that you're interested in. So that's really the name of the game for this. We'll cover 5 questions. I ended up just randomly picking them out of the hat so I wouldn't have to, choose between all the different types of questions. But let me start and we'll do this quick. This will be like a bi-weekly, every 3 weeks, something like that. So number 1 question, here it goes. Do you like the 2-year bond at 4% versus, let's say, stocks? So at a moment here, just before to think about it, and when you think about the 2-year bond, it's so attractive, right? At 4%, it's really trying to tease you to try and buy it and hold it for 2 years, and versus look at a 10-year bond trading well below that, and that's why people look at it and say the curve is inverted. There's different ways to parse that out, whether inflation today versus inflation in the future. But the 2-year bond, let's say, I think today, Friday, January 6th, is below or around 4%. For us, if you take the reciprocal of that, right, 1 divided by that number, you get something like a 27, 28 times multiple. That's a way you can assign kind of a like-for-like multiple on a bond versus a stock, let's say, or any investment in general, and say, what multiple am I paying for this? And, at 27 times with, in theory, call it no capital gain potential on a go-forward basis, because it's 2 years out, it's not that interesting. And it's tempting. I get it at 4%. But ultimately, what you're comparing that to is, the equal weighted S&P 500. And again, we don't invest in the index, but an equal weighted S&P 500 here is, trading at 13, 14 times. So you do the opposite of that, right? And you get something closer to 10% in terms of the percent that earnings yield that you're generating. So the earnings yield versus kind of a 2-year bond. So for me, and again, this isn't advice, that 4% yield over a 2-year period is tempting. It's more people trying to hide away. Actually, what you're seeing is, in my opinion, is more people are buying the long end, right? And buying the 10-year, the 30-year, which is why it trades, why the yield on that 10-year, that 30 yield is below. So a lot, call it smart money, bigger money, has been thrown towards the longer end of the curve as opposed to the shorter end. Obviously, the Fed's involved and things like that. Okay, cool. Next one. What is out of consensus that you feel worth mentioning? So there's probably a couple here. So first half, second half kind of concept I keep hearing thrown out, the first half versus the second half. The first half is going to be worse and the second half is going to be better as we get through the cycle. And the first half is going to continue to have the Fed at the forefront of everything that's going on. I think that's ultimately true, but I also think we all know that, right? And that's consensus. So typically, again, we don't try to go against consensus just for the purpose of being contrarians. But when you think about it, again, you go back to the prior question, which is really around the yields and the multiples on investments. I think, at 13 times the equal weighted, the average stock at 13 times, a lot has been discounted into the markets. Even if you get, a 10, 20% haircut on earnings, just re-rate that or move that multiple up higher because that's what earnings would, the earnings number would adjust for that. So I do think this first half, second half concept is worth mentioning. I do think it's consensus. That's the consensus view. I think it could possibly be the opposite of that because people, the money tries to get ahead of whatever's going to happen. And if the second half, in theory, is going to be better than the first half, then wouldn't you put your money in the first half relative to the second half? So I think that's just it's a weird prediction in general, because I don't know how anyone can, with a real foresight, try to think through, a 6-month period. Next is, I think, again, at a consensus, and I was just listening to a big ad buyer. Digital ads, in my opinion, are going to hold up stronger than I think people are giving credit. And why I say that is, I think what we're seeing here is digital ads are now becoming a tool. And the more people I've spoken with like the fact of digital ads versus some of the physical counterparts that you can choose to invest behind. And the reason behind that is you can turn it on and turn it off. So it's a negative for companies in the very short term, but it's a really strong positive for these companies as well, because the customer, the advertiser, doesn't necessarily turn off these platforms. So I do think as advertisers continue to appreciate the ability to turn it on, turn it off, and things like the jobs report remains fairly healthy, and the economy, in our opinion, I think at the end of the day, this comes to the equation again: hard landing versus soft landing. What you're going to see is, or at least what we think is, the jobs market's pretty strong, balance sheets are still pretty strong across the board, and we're on pace for a soft landing, a softer landing, if a landing happens at all. And ultimately, what that means is you're going to keep your ad budgets on for the most part, unless there's some sort of shock, and then you quickly turn them off. But again, if you're in the soft landing camp, I think what ultimately the consensus view then is, we're going to have a hard, or at one point we had a hard landing kind of consensus, I think was out there, or somewhere in the middle, mid landing, if you will, that digital ads wouldn't hold up. And again, I'm hearing anecdotally that, in different categories in different areas, people are keeping their ads on because they know they can flick them off immediately. Number 3, what theme will come out of the economic downturn? So I think there's a couple here. One that we are, very much associated with in terms of analyzing and understanding and investing behind. Again, not advice, but the freelance ecosystem. I think digital freelancing in general. So to just strip out digital, but digital is making it easier to kind of like find a place. Why I say that is so many people are, specifically in tech, you're hearing layoffs from different companies. These are highly sophisticated people for the most part, depending on who they are. And some of the traits are everywhere from like sales, marketing. That's some of the people that are getting let go. And, the freelance ecosystem is typically known for that type of work, which is kind of like design, marketing, kind of these project based where, you can be remote in a way. And so I do think as a lot of these people are let go, what you're seeing more and more are people immediately trying to build their own thing. And as you build your own thing, and now you have more tools like the freelance marketplaces that exist today, I won't name them just for the purpose of this, that you turn to those in the midst of a downturn. And in the upturn, a lot of those new business formations that do occur, I think will help, will prosper during the out years of an economic downturn. So I think that theme will play a lot this time around, because a lot of people aren't immediately, I think, searching for a new gig as opposed to just trying to build something themselves. I know several friends that have done it as well. Call it some of the platforms on their earnings calls. They've mentioned as well that they're seeing record amount of new listings, new gig workers on their platforms. So again, I think we're seeing that, and that's what I expect. One big problem, because again, we're trying to find areas that are where there's a problem, where something could be solved. His housing affordability, car affordability, with rates rising. You think of what's driving the issues out in the world. It's really around affordability driven by rates rising. So that has to be some areas that thrive in terms of innovation and people creating new types of structures around affordability, whether it's kind of the rent to own or rent to buy, but in different types of faces to them. So I think there's going to be a lot of stuff that happen there. Number 4, again, I picked this one out of a hat, but Apple's starting to crack. Why do you think that is? I've owned Apple for a long time in my investment life. And, years ago, it started to approach, the mid 20s to high 20s to I think it touched 30 multiple, you know. And for us, here's a company, when you underwrite investments to 15 times, 10 to 15 times, what we think their steady state growth is and steady state margins are. Um, at some point, companies all get there and they stop growing, and you have to assign a multiple on these companies. And typically, the best companies in the world tend to fall in the 10 to 15 times multiple. Look at all the legacy old dinosaur tech that everyone's attached to today. That still hover in that 10 to 15 multiple, the Oracles, the IBMs, and some others. So my point here is that at a 30, a high 30, a high 20s multiple on a company that probably seen most of its real growth behind it, I think it just set up not well for a smooth next couple years. I do think, again, this isn't knocking a company because obviously it's arguably the best company in the world, and they've done everything right. It's not their problem that it's down 30% from its highs now. And a lot of people are hiding out in this because it's such a big weight in the index. So you hide out in it, you can't get in trouble. And what you're seeing is, you see some rotations happening in the markets, and I think that rotation is a byproduct of maybe some people exiting the big things that they've been in. Look at Microsoft as well. So I just think it's a valuation question here, and a hideout question. So it's defensive, safety, high multiple. Generally speaking, as people start to open their door to potential other investments or just investing in general, they'll get out of the big safe stuff, and that becomes a source of liquidity for everything else. There's two here. I don't know why there's two more because I was going to end at 5, but I will go with one of these. You speak a lot about transformation. What areas are you looking at that pique your interest? So I think 2 of them really around, so transformations for us is really around, really good businesses that have really good brands, historically really good businesses, and they still may be good businesses that are going through some form of transformation. That transformation moment is important because, generally speaking, what happens is you have a dislocation in the investment, in the valuation of this business, i.e. dislocation in the stock for the public markets. And that drives opportunity. Now, as an investor, analyst, you have to decide whether this is truly opportunity. And that's why, again, you want the backing of a really good brand and a user base, a sticky customer, and something hard to replicate. So like a very mode type of business, economic mode type of business, right? So cruise ships and airlines. And I know at first thought, you're like, what? Cruise ships and airlines? And I think it's just that, here's 2 areas that got hit pretty hard out of COVID, mostly from a top line perspective, revenue, then a margin perspective as well, obviously, because revenue and all these fixed costs. On top of that, a lot of debt was inherited during those moments, not to their own doing. And today, what you're seeing are really strong cash flowing businesses. The multiples being paid for these assets are incredibly depressed. Specifically in some of the names, and I won't go into the names. And again, right here was what areas are you looking at that pique your interest, not what are you currently investing in. And so you have an interesting setup, low multiple. Many of these businesses, brands have proven their ability to, survive. Not only survive, now they're thriving in a sense. They're overwhelmed with debt. Now, is there? You obviously, as an investor, you have to draw the map forward and say, okay, how do we go from a highly debt company to a less debt to maybe a no debt company over the next several years, and what will that do to the equity value of this business, and then what multiple will this go to? So that's what is piquing our interest from a transformation side. These are companies that are going through transformation. And that is it. So, that was 5 questions. I think a lot was there in different areas. There's probably 40 more questions now in this bag, and some of them will be reasonable. I open up right before I get on here and pick the 5 out of a hat, in a sense. So with that, I will see you next time. Stay tuned and have a good weekend.